First of all, thank you for everyone for hanging on from the last webinar, and welcome to this new monthly webinar. I'm very excited about this new topic, trading Japanese candlestick patterns in volatile markets. You're here today with Ron Williams, technical strategist from MIG Bank, and hopefully I should be speaking to some repeat audience, so people that would have attended previous webinars. If I can start by asking the question, how many people in this webinar attended previous webinars that we had posted from MIG Bank with FX Street? If you can just quickly say yes in the chat or even no. So more yeses than no's, that's always a good sign. The no's are also positive because it means that there's a new audience out there that are finding our webinars interesting. Welcome to all of you, and just one quick thing I want to mention is that for any questions that I don't get to answer during this webinar, please feel free to reach out to me, email me on r.william@migbank.com. Also, the MIG Bank have a Facebook website, a Twitter @MIGBank, and on the FX Street website, forexstreet.net, we have a live blog which I just activated yesterday with a few comments. Okay, so I'm just going to quickly move on to a little bit about me and what I do. I've been in the industry for just over 10 years. Very, very big researcher and trader in technical analysis. And the three techniques which I use on a regular basis for the course of those 10 years are right now on the screen. So if you can just look at what I'm showing you. The first point is market cycles and geometry. Market cycles and geometry is basically all the different timing aspects to the rise and fall of the market, but also how that interchanges between different markets like foreign exchange, commodities, and various other markets. Secondly, of course, Japanese candlestick trade setups. This is something I've specialized in for many years. Actually, from the first time I started in the industry, I started looking at Japanese candlestick patterns. And actually, an interesting story which I can expand upon later is that when I actually started, I was asked by the chief strategist to actually start drawing out price data on graph paper, and candlestick charts were the first type of chart that I used to draw out on paper. Thank you guys for the positive feedback on our post on FX Street. Appreciate that. Last but not least, in the techniques that I've covered over the last 10 years is the mark indicators and proprietary strategies. For some of you who may or may not know, DeMark indicators is basically developed by a prominent, well-respected investor and trader called Tom DeMark. And during my latter years at Bloomberg, my prior employment, I had the honor of working with him and developing some work on his studies. So these are the three areas I focus on: market cycles, Japanese candlestick trade setups, DeMark indicators, and proprietary strategies. Now, I always like beginning with the end in mind and focusing on exactly what we're going to cover during this 45 or more minutes. I hope the FX Street guys allow me a bit more time. Smile, smile. We're basically going to cover what you can see on the screen. A brief history of Japanese candlesticks, the history, a quick note on Sakata, one of the famous Japanese traders many centuries ago. What lessons does it offer for today's traders? Advantages and challenges. I won't go in for it word for word, but we're going to cover just exactly why you should be interested in Japanese candlesticks, how this can make you money, and most importantly, how it can help minimize the losses or at least manage the risk that we face in such a volatile market environment. The second half focuses more on candlesticks 101 basics, what you need to know. Now, keep in mind there is an exclusive kind of 3-hour webinar that will be taking place in July. The team at FX Street is probably going to promote that at some point during this webinar that I'm giving. So a lot of the really good and valuable stuff will be kept for that. This will still be a very interesting webinar, but obviously I've kept some of the very exclusive stuff for that 3-hour webinar, which will be in the next few weeks in July. Now, the second half of this webinar, Candlesticks 101 Basics, you do need to actually focus on this part of the webinar in order to really kind of make the most out of the part 2 advanced session that we do later on in July. Lastly, profitable strategies. I talk about the power of confluence and then golden trading principles. So that's basically what we'll be covering today. Now, before I actually move on, I just wanted to ask a quick question. How many people use Japanese candlesticks on an active basis? So when you, first thing in the morning, you want to make a trade, you want to make some kind of analysis, how many of people in this chat use candlesticks? So can you just say, yes, I do? Okay, so quite a few people. That's a fantastic and interesting point. And in anywhere around the world or any clients I speak to, I always ask that question, whether it's 5 people or 200 people, how many people actually use Japanese candlesticks? And interestingly, usually about 50-60% of people or more raise their hands. There are still people out there that use basic classical bar charts, i.e. they don't use candlestick charts. That I think will change in the future, but we'll focus as to some of the reasons for why that is. Now, I'm a big fan of history, and it's one of my pastime passions, and I believe that history actually allows us to understand a lot when it comes to Japanese candlesticks, most specifically because this is the one trading technique in the world that is over 400 years old. This is the one trading technique in the world which is over 400 years old. And so some of you may already know the story that well over 400 years ago, before the United States became an official country, and many other historical points in time, Japan, one of the very few countries around the world, were actually trading, actively trading. They had their own futures market, and they were at the time doing rice. This was one of the most earliest commodities that were being traded around the world. Later on, I think about a century or two in Belgium, they were trading cotton, and various other stock markets and commodity markets then grew thereafter. But a lot of the history actually began by using rice in Japan. Now, rice wasn't just a commodity that people had for breakfast, lunch, or dinner. Rice was actually the equivalent of modern-day money. So 400 years ago in Japan, when they actually were paid in wages or they would exchange goods for goods, they would actually exchange sachets of rice. So rice was as important as money is today. And so for that reason, when they were trading, of course, trading rice was exactly the same as trading money. Now, the way that they would do that, these rice farmers, these kind of privileged agricultural traders, was by focusing on market psychology. And what a lot of people maybe don't talk about enough, seasonal cycles. So obviously, the fact that rice, like most commodities, is grown and weather affects these natural resources, it was very important for a lot of these traders and investors at the time to understand how the weather and how certain seasonal cycles influence the market. One step back, market psychology is the be-all and end-all in technical analysis. So an understanding of how human emotion is ultimately what decides where price moves, up or down. It is human emotion that actually decides that. So these two areas, market psychology and seasonal cycles, were the big areas that they focused on. Now, an interesting point is that back then, Japan, being an isolated island, engaged in a lot of warfare. And because of this kind of warfare-like history, a lot of the terminology which you'll learn when you actually study Japanese candlesticks has terminology which is either linked to military tactics or maybe to some kind of symbology in terms of their Buddhism or their Buddhist legacy in terms of spiritual meaning and symbolism. Last point, most trading signals are contrarian, and that basically means in English they anticipate price reversals. This is actually the single most number one reason why Japanese candlesticks is so important in your kind of arsenal of trading tools, and probably why it's so much better than any other trading technique that you might use in isolation. Okay, so that's my brief snapshot on the history. I'll keep on saying this. This and other areas will be focused on in more depth in the larger 3-hour workshop on Japanese candlesticks coming up in July. Now we're going to switch into advantages and challenges. What makes this technique superior? I've just mentioned that. Timing is everything, especially in volatile markets. And then just a point about having a successful strategy using candlesticks. Now, these are the three reasons why Japanese candlesticks, in addition to calling reversal points in the market, these are the three reasons why they are superior to any other trading technique. The first one is it's visual. Now, most people that do kind of most mind analysis in terms of how the human brain works and how humans respond, about 70% of anything that moves in your brain or that calculates things in your brain is actually stimulated by anything that is visual. Pictures speak 1,000 words, literally. And when you're looking at day-by-day signals that are generated by candlestick patterns, this becomes a very important principle to keep in mind. Secondly, timing. Timing is everything, especially in volatile markets. And certainly candlesticks offers you a lead edge in timing across any indicator that you can imagine, and other techniques, classical techniques which you may already use. I'm going to make a quick point about this. For some of you who maybe look at chart patterns or draw a trend line, this is stuff I do every day in the analysis that we do at MIG Bank. Keep in mind that it may take a few weeks for a trend line to form. You need several points to actually match that trend line. A chart pattern can take several months, and so on. So a lot of these classical techniques provide context and they are very important, but the actual day-to-day timing is probably exclusively driven by candlestick patterns and anything that is related to that type of technique. Lastly, it enhances technical analysis. Using Japanese candlesticks doesn't necessarily mean that you stop using everything that you already use. So whatever you use out in the market at the moment, whether it's trend analysis, Fibonacci analysis, Elliott wave, all the indicators that exist in the world, you can carry on using this analysis. You don't have to change anything that you're doing at the moment. All you need to do is just switch your thinking and add value to what you're already doing. Leverage that strategy you're already using. Is that clear for everyone? Does that just make sense? Visual, timing, and enhances technical analysis. I'm going to move on just to the next point just because there's a lot of important stuff which I need to cover in this webinar. Okay, now the first thing, I believe in kind of proving what I say. So instead of kind of just talking the talk, I'd like to give you a visual example of why candlesticks are superior, visually at least, over any other chart technique. So this is a bar chart, just basically a chart that shows you the open, close, high, and low of any trading session. And this is a chart of gold that we're looking at. So it's a topical market as we speak, having made a high around just beneath 1600 at psychological level. And as you can still see that it's an uptrend. Ever since January and even beyond that, the market in gold, as most people know, even if they haven't been looking at the chart, has been rising. It's even been tripling in value. Obviously, since April, gold has moved sideways, and you can tell the direction of the trend just by looking at any type of chart. Okay? Now I'm going to switch from this bland but interesting chart of gold bar chart to a candlestick chart. I want everyone to focus on the screen and just tell me what you see. So this is the bar chart, and I'm just flipping to a candlestick chart. Candlestick chart, back to the bar chart. Candlestick chart, back to the bar chart. One more time, until everyone gets bored from this example. Okay, last time, bar chart, candlestick chart. Now, can anyone tell me the first thing that springs to mind? What is the first thing you notice when I switch from a bar chart to a candlestick chart? First thing that comes to your mind. Anyone? I like all these webinar sessions to be as interactive as possible, so please feel free. Okay, so one person's saying it's three-dimensional. Absolutely. You get a lot more price information. It's almost like a three-dimension. You see black candles. Agreed. Color comes into play. So color is very important in terms of kind of adding that three-dimensional visualization. And when you're looking at the bar chart, it's just a black bar chart. When I flip over, it's a three-dimensional color-coded pattern of market movement on the chart. So immediately you can see who is buying, who is selling. You can find out how much they are buying, how much they are selling. And of course, if you actually properly study the different patterns that are set up in the market, then you can actually maybe try and forecast highly probable turning points in the market. And anyone in this conversation who's here to make money or to at least minimize their losses knows how important it is to actually get a leak signal on turning points in the market. So immediately you can see my point. Some people saying the bar chart is just a maze, and so on. Okay, so I've made my point. I'm going to move on from that. Now I want to focus on the whole timing aspect. Now, in a lot of the webinars that I've given over the last few months, I've given one every single month, a webinar every single month for the past 4 months, I think. This is the first educational webinar which I have given, and I'll give a lot more in the future. But one of the topics I keep on talking about is the changing environment in the market and how the market has basically become a lot more volatile. If you are making some money in today's market, that's a very good thing because things are a lot tougher than they used to be. And the main reason is volatility. Now, this diagram here that I'm showing you is a statistical diagram which I've used for many years in presentations and trainings that I've given. And it just basically shows you a statistical chart of probability. This red probability curve shows you the probability of basically market shocks taking place. So you can see the ends of this probability curve, which I've highlighted with the blue arrows, show you market shocks, or as some people otherwise call them, black swan events. So rare events in the market, which is the metaphor for black swans, tend to happen a lot more frequently, and this is a statistical diagram just illustrating that. Now, this actually affects the very markets that we trade, and this is an example of how volatility affects the personality of trends in the market. Now, I like to refer to the markets as people. They are driven by human emotion, and most people understand when we talk about people, think of your family, your best friends. Everyone has a good understanding of certain people in their lives. And it's the same thing when we look at the market. You have a good understanding of a market or a person. You tend to understand how they might act in certain situations. Now, put that situation in a highly extreme situation like a volatile market shock environment, you tend to get certain results. Now, I've shown 4 results. First result and the third result is basically a trending or ranging market with low volatility. The second and the fourth example is a trending and ranging market with high volatility. So all I'm basically saying is there are 2 things that can happen at any given time. A market can trend up or down, or it can move sideways. It can range. But during that time, what affects and influences the characteristic of that market, the personality of that market, is the volatility. Does that make sense to everyone? I'm just basically saying that high and low volatility is the one thing that truly affects the personality of a market. Now, chart 1 and 3 show you low volatility markets. Chart 2 and 4 show you high volatility markets. And the key thing here, if you haven't got what I've kind of said, let me try and clarify it in a more practical way. If you're trading the market in, actually, let me take a step back. Let me ask a question. Which of these charts do any of you prefer? If you're trading tomorrow morning, euro dollar, gold, the S&P, the Dow Jones, which one would you prefer? Number 1, number 2, number 3, number 4. Quick survey. Okay, someone said number 2. Someone says number 1. Okay, I'm great. I'm really happy now because all of you are switched on. One person said number 2, which is fine. You're probably a swing trader, for those of you that understand what I just said. But the majority of you have said number 1. And I actually expect more people to say chart number 1 than any other chart on this screen. Now, can anyone tell me why? Why do you choose chart number 1? So the people that said chart number 1, why would you prefer to trade that market tomorrow morning? So one person said the market is trending. Absolutely. It has a probability of going up. Most strategies would work. It's easier. The key word there is it's easier. It's stable. You can trade the market in example number 1 with most trading strategies, and you're more than likely to make money. You can even have a strategy which is incorrect, wrong, several times. You can basically afford to make mistakes in example number 1 several times, lose money, but you won't lose too much money, and you'll probably still make back a lot more money. And that's basically because the market is more predictable, it's trending in a very obvious way, and the volatility in that market is very low. Okay, so that's basically it in a nutshell. Chart number 1, or any market that looks like that, is a calm market. It is an easier market to trade or invest in. Now, if I compare it with chart number 2, this shows you a market which is still moving higher. It's still trending, but notice the yellow circles which I've animated on this chart. It shows you that along that uptrend of higher highs and higher lows, the market's moving higher, but there are these very sharp corrections or drawdowns. Now, for me to explain this in black and white, think of yourself walking down the road and then all of a sudden getting a heart attack. You're still walking down the road, you're still doing something which is very predictable, but along the way, you're actually having a heart attack. And that heart attack, that seizure, is very hard for you to manage, just as the same way it would be very hard for you to manage psychologically when you're trading this position. So the point is this is the difference of volatile markets. In terms of candlestick patterns are most useful in these types of markets. Chart number 2 and chart number 4 are probably the best markets to trade Japanese candlesticks. And the main reason is the reason that I started off with. Candlesticks allow you to basically time market turning points. So it allows you to basically gauge market turning points. So of course, if there are more market turning points in a volatile market, then candlesticks tend to help you more, and especially people who swing trade. And yes, in answer to that question, swing traders do prefer candlesticks. And just one other point which some of you might find interesting, since we are doing a webinar on FX Street, Japanese candlestick charts are the most widely used charts within the FX market globally. And some of you who use Japanese candlesticks probably know why, in addition to some of the reasons that I just mentioned. Now, moving on to the next point, 101 basics. I'm just going to highlight what you need to know. The first point is what I call CPI, construction, psychology, interpretation. These are the 3 things that you really need to know. So for the webinar that you attend in the next few weeks, the 3-hour webinar, which I do exclusively for FX Street, you really need to know the stuff that I'm about to show to you, just so you can really leverage the trading ideas which I show you afterwards. Then I'm going to give you a kind of a secret tip to understanding all the various candlestick patterns out there. This is one of the things that took me years to understand, but when I did understand it, it really helped a lot in my trading strategy. So that's candle groups. And then finally, I'm going to make a point on the importance of trends. If I'm able to cover all of these points and I still have time, then I will finish this presentation. If not, we'll have to leave a little bit for the next time, just to keep in time with the time allocated. Okay, so the first thing, just a quick kind of snapshot on candlesticks, a real-time snapshot. On the left of your screen, you're going to see a real-time market move. The market opens, prices rise, and you can see the color of the candlestick. In this example, is white. The close is above the open. So the close is higher than the open. The market has risen. So if you can think of euro-dollar maybe trading at 140, pushing up to 150, and it closes at 150. It's been a positive price move in the market. The color tends to be white. You can choose any other color that you want. Classically, it's white for up moves. The same is true, but inversely on the way down. The market opens, pushes down, and then closes beneath the open. So here you can think of crude oil, which has been negative recently, maybe opening at $120, pushing down to $100, down X dollars. And so the move is down, the close is beneath the open. The color is black. Everyone fine with this? Just for some of you who may be kind of new to this, I want to make sure that everyone's on the same level playing field. I want to make sure everyone's on the same ground. Now, the names of this price move, open, close, whether it's positive or negative, is RealBody. So the Japanese strategists and traders many centuries ago, when they actually decided what was the most important price movement in the market, they decided that the difference between the open and the close, a market opening and a market closing, was actually the most important price activity in the market. They actually said more than that. They said it was the essence of market psychology. So to understand the market's real psychology, the direction of the market, you really need to know where the market opened and where it closed. This is, in essence, the market's commitment to a price point in the market. So think of the difference in the open and the close, a market commitment, or the essence of price psychology, market psychology. Now there's a flip side to that. The other side of this coin is the extremes of the session. So the RealBody shows you where the market opened, where it closed, the difference between the two. But the extremes of the trading session, the high or the low, is also important. Now, in Japanese symbology and kind of spiritual understanding, they allude to a lot of these yin-yang meaning, so positive and negative. And think of the yin part of that combination as the real body in the market, the essence of psychology. The yang part of that combination is the shadow in the market. So the two things you need to keep in mind when you're looking at candlesticks: one, real body; two, the shadow. Real body shows you where the market has committed itself. Shadow shows you where the market was but isn't anymore. Now, if you're not entirely sure on what I've been saying now, don't worry, I've got a few examples coming up in the next few moments that really kind of clarify what I'm saying. But just understand two buzzwords: real body, shadow. Real body, shadow. Real body, it shows you the difference in the open and the close. The shadow shows you the extreme points in the market. Is that okay for everyone? Most of you already know this, but just for some of you who might not know this, I just want to make it very clear to some beginners out there. Okay, that's just a real-time example. Now I'm going to quickly show you the psychology. Let's say the market opens, pushes down, rises, and then follows this price path during the day. And then breaks support. These are the emotions that go through us during the day: greed, fear, hope. But during that time, what you get is a lot more if you actually trace out the candlestick. Now, if you just focus on where the mouse is at the moment, I'm highlighting the opening price. This is where we open. This is where we closed. This is the high of the trading range, and this is the low of the trading range. Everyone with me? So I'm just basically tracing out an intraday or intra-week or intra-month price activity. That's what I'm showing. Down, up, and then finally down, breaking down with the emotions. Now, the opening price and the closing price allow us to highlight the real body, the real market commitment, which has been down. The high of the range and the low of the range allow us to highlight, and some of you can probably say this without me saying, the shadows. And so this is just a real-time example just showing you how all of this price information during a day, week, or month is crystallized in a candlestick, one single candlestick example or even a pattern. So just keep that in mind. Although it's a very simple example, I found that whenever I've showed this to people, it really helps explain the importance of candlesticks. It's not just one or two or three patterns. It actually unlocks a lot of really important, valuable information that takes place during the day. You can understand all of this price action in just one single candlestick. Is that clear to everyone? Just going to wait for a quick yes from anyone, just to make sure that I'm hitting a few good points here. Okay. Thanks, everyone. Okay, now I'm just going to have some fun here with a few kind of points as to why the real body and the shadow is important. Whenever you're looking at the real body, thanks, all feedback is good, especially positive, so keep it coming. We're focusing on the yin-yang relationship between real body and shadows. Difference between the open and the close, and then the shadow, where the market was but isn't anymore. So I'm going to focus on each of these points separately. When we look at the real body, keep in mind it's the essence of market psychology. This is a battle between bulls and bears, buyers and sellers, demand and supply. Whichever term you prefer, this is what we're looking at every single day when we look at a chart. Now, when we look at the real body on a chart or a candlestick chart, the question we should all be asking ourselves is, who is in control? Are the bulls, the buyers, demand in control, or the bears, supply, sellers in control? Who is in control? So whichever term you prefer, who is control? Buyers or the sellers? Now, it's not always easy, but I'm going to show you a picture for some of you boxing fans out there. The famous fight between Muhammad Ali and Frazier many decades ago. But it's a good picture that I picked off of the internet. And the question that I asked of each of you here is, in this picture, who's in control? Frazier or Muhammad Ali? Okay, we have one person saying Ali. Could be a supporter. Anyone else? Okay, everyone's kind of saying, most people are saying Muhammad Ali, some people are saying Frazier. This is not an easy question, and I look at this many times, especially when I'm showing this to people, and I ask myself the same question. Frazier is probably the easiest example of someone that is in an attacking position, someone you really think is winning the fight. He's throwing a left hook, maybe his prize punch, but when you look at Muhammad Ali, he doesn't look out of control. He's basically stepping out of the way. And so interestingly, it's just a counter move to what his opponent is doing. And so it's almost like a checkmate situation between these two very good boxers. And this is often the situation in the market where it's very hard to answer the question, who's in control? The buyers, the sellers, bulls, or the bears? Keep in mind that, these are the questions that we ask ourselves often. And in this example, the way to understand this is to obviously follow the market and to focus the real body, the essence of market psychology. Obviously, I threw in this example because it's a tough one, just to kind of encourage you to kind of think about this a little bit. Now, the opposite is true when you're looking at shadows. This is an example of different types of shadows in the market, and I've specifically put in shadows which are a little unorthodox, just to kind of make sure that this is as educational as educational as possible for you guys. I want to make sure that each of you are learning something new and useful. So shadows are not just extremes of the day. Shadows show you who's losing control. So that example, that boxing example where I showed you of Muhammad Ali and Frazier, equally, that the other question you can ask, not just who's in control, but who's losing control. And one of the ways that you can answer that question, the other side of the question, is by looking at the shadows, the extremes of the session, where the market was but isn't anymore. Another description of that is, I've just basically said, shadows show you momentum which is decreased. Now, I tend to kind of speak in terms of different definitions just to make sure, that each of you have different definitions that you might relate to. But to give you a practical example, the first candlestick is a bearish long upper shadow. So it's a positive day. You can see it's a white candle. The market opened, and then it pushed higher and closed above the open. So let's say euro-dollar opened at 150, closed at 150, but it made a high at 160. I'm obviously speaking hypothetically here. I don't believe euro-dollar is going to move to 160. But it made a high at 160 hypothetically, and then closed down at 150. So you should be thinking two things here. One, the market was strong, but two, it then lost some of that strength. So the buyers were in control, but at the end of the session, they started to lose control. Is that clear to everyone? So again, I just want to make sure this is making sense to everyone. If you can just quickly say yes, great. Everyone understand this. So it is a bullish candlestick, classically, but you should really think twice when you see something like this, because the shadow is a leading signal to strength which is decreased. So buyers that were in control but are now losing some control, and most importantly, they're losing control right at the end of the session, which can sometimes be the be-all and end-all. It doesn't matter if it's early session or end of session. If the buyers or the sellers lose control, they lose control. It is a dynamic game. Now, the second example shows you the same thing, but in a market context. So here we have a market trending up. The market then hits a key level, maybe a psychological level, gold, 1,600, oil, let's say $120. Any psychological key resistance level you can think of in your mind. And here you have a market which was in an uptrend, that's the green arrows, but then it makes further highs. But then as it makes the highs, the shadows then show you that the buyers are losing control. So this is bearish long upper shadow showing you decreasing rallying strength. Last but not least is the exact opposite, and this is what we call a bullish long lower shadow. So most of you will look at this bearish black candle, these two bearish black candles, and say to me, this is negative price action. And you're exactly right. But you're also wrong at the same time. Because although that sellers are actually in control during both of these sessions, the fact that the market pushes up at the end of the session, so remember the market opened here and closed here, but then it lost this much price action. So this is showing you that sellers have lost some control, almost 50% control during that trading session. Okay? So we haven't covered any patterns yet, and I'll quickly kind of show you a few pattern examples in the last few minutes that we have. But if the single one message you understand from all of this, understand that, the real body in the shadow tells you a lot more than you think. It really does tell you who's in control, and it really does tell you who's losing control. And you should always focus on these two parts of the yin-yang relationship in Japanese analysis. Now, here's a quick example I want to quickly just show you of a bar chart. And my question is, what is the bar chart showing you? First thing it's showing you is the market is trending up. Everyone can see that the market makes a higher high, then a higher low, and then finally pushes further higher. But what else can you see? What do you see in the green circles? If I can just get a quick point. Someone just said here, most candles have shadows, so to worry about the wicks would be exhausting. I agree with you, but the size of the real body and the size of the shadow really matters. So you make a good point. There are many candlestick patterns, hundreds, and this is part of the challenge and the problem with candlestick patterns. A lot of people are afraid to learn about candlestick patterns because they find that there are too many and they're hard to remember. Also that they find that, there's a lot of duplication, there's a lot of real bodies, there's a lot of shadows. So a lot of it is really kind of training your mind and obviously using a tried and proven trading strategy using this methodology so that you can use it successfully. And obviously this is what I'm going to try and finish on today, but definitely focus on in more depth in the exclusive webinar in the next few weeks. Okay, so back to the question. Some of you said 4 dojis, close a higher. Okay, if you can think in terms of bar charts, so I know we've been talking about candlesticks, but I want to take a step back and just from a bar chart perspective, what can you see? Most of you are saying the correct answer. The closes are higher. So if you were watching this on television or you're reading a newspaper, the market commentator would probably say this market has made a consecutive high. It could be oil, it could be Eurodollar, it could be the US stock market. It's made 4 consecutive highs. So on a closing basis, I should say, it has moved higher. So this close is high, this was above the previous one, and so on and so forth. So 4 trading sessions, this market has closed higher. Now, if you were just doing the line chart, that would be positive. If you're doing a bar chart, it also looks positive. Now, I'm going to just show you what I just said. It should be 5. So 5 consecutive higher closes. 1, 2, 3, 4, 5. Now, my question here is I've got one person here looking quite exhausted. This is actually happens a lot if you're climbing the mountains here in Switzerland where we're based. If you start at the bottom and you climb to the top, you get exhausted. A bit like Eurodollar, a bit like gold, definitely silver. These are markets which have risen to great heights, but towards the top of that rise or that mountain ascent, they have lost some momentum, they have become exhausted. And so the question that we must always ask ourselves when we see a market trend, a trend is your friend, but you always have to ask yourself the question, are there any signs of this trend exhausting, losing momentum, running out of steam? Is there any sign that this trend is about to reverse? Just as if you were climbing a mountain, is there any sign of you becoming tired and then potentially not being able to make it to the peak and then walking back downstairs again? Okay, I tend to use a lot of metaphors just to kind of make it really clear in your mind. But this is just a visual cartoon example of what might be happening in this market. So although we've got an uptrend, although we have 5 consecutive higher closes, we should ask ourselves the question, is the market tired? Now the Japanese have a famous saying, which I tend to love. They have 1,000 proverbs, but one of the proverbs I like the most, beware of the market that rises in agony. I'll say it one more time again. Beware of markets that rise in agony. So it's a twist. The markets rise, but are they rising in agony? Are they in pain? So just, again, think of yourself climbing that mountain, and towards the top part of the peak, you're exhausted and you're really starting to feel the pain in your knees and in your muscles. And so these are the markets where we really kind of need to be a lot more kind of focused on risk, money management, use tight stop losses, and maybe think of kind of lightening the trade. Or, in this example, look at your candlestick patterns to try and get more of a color, more of an X-ray vision as to what might be happening in the market. Okay? It might also show that the market is resting. So that's a very good point that someone just made. It's not always going to show you a market reversal, but it may just show you that, that there might be an important continuation pattern before the market continues higher, or it might end up being a reversal. Now I'm going to quickly show you the example through a candlestick pattern, bar chart, candlestick, bar chart, candlestick, and you can see straight away it's a three-dimensional, color-coded, almost X-ray vision into the market. You can really see the buyers and the sellers, the buyers in white, the sellers in black, and most importantly, within the red circle, the 5 or 4 consecutive higher closes look a lot more concerning now. One, because the real bodies are very small, and real bodies tend to illustrate or symbolize indecision in the market. If the open and the close are very close to each other, it basically shows you that the market opened at 1.1, it closed at 1.2. Nothing has really happened during the day. So there hasn't been that much market commitment. And in this example, as someone just said in the chat, buyers are slowing down. Equally important, when you see this big shadow here, this big upper shadow, this is a very bearish signal. And this shows you that although the market moves higher, the real body or the market commitment is less. That's the first point. Second point is the big shadow is showing you that buyers were willing to kind of push to further higher in the sky, but they were unable to hold their ground. So sellers moved in and started to actually push down the buyers. And so, again, think of the boxing match between buyers and sellers. Who's in control? Who's losing control? So clearly, the buyers are losing control in terms of the real body and in terms of the shadow. Now, this wouldn't be a textbook reversal signal, but it would at least highlight the fact that you should start to be cautious on this particular market. So you might start to focus on your risk-reward ratio, your stop losses. Maybe you start to lighten up on the trade instead of going very strong on this. Or maybe start to look at other markets that look a lot more prettier. Okay. In this particular example, you can see the shadow of the real body, which I've just been talking about. And as with most of my examples, I put in cartoons just to kind of make the point in a light, humid way. You see this guy who's obviously been trading the other way and not looking too happy. Okay, is that clear to everyone? I'm going to move on now from this point and just focus on the basic candlesticks in the last 2 minutes that we have. Thank you, FX Street, for the extra time that you've given me. I have noticed that you've given me extra time. Always appreciate it. Now, basic candlesticks that we're going to end off on. Long candlesticks, bullish and bearish. Doji candlestick, that's when the open and the close are the same. And then these are 2 other variations which we don't have time enough to go into, but just keep it in mind. Long candlestick, doji candlestick, that's the most important part. Okay, now long candlestick just shows you strong buying and strong selling. Doji show you that the market is either undecided or tired, and then spinning top and high wave are variations of the first 2, which I'll talk about later in the next webinar. Now, the big problem with candlesticks, the big challenge out there is that there are many candlestick patterns. There are over 100. Now, remember I said that before the end of this, at the end of my webinar, I was going to try and give you a secret tip that I learned years later working in the industry, and that is how to really kind of simplify candlestick patterns. There are over 100 candlestick patterns out there, so the best thing for you to do is to think of families. Think of your family tree. Just isolate that family tree into parents, siblings, cousins, whatever. But think of family groups. And here I've just kind of put candlestick groups that allow you to kind of quickly break down all the 100 candlestick patterns out there into identifiable and tradable groups. So the first two groups you should all know. First of all is reversal patterns, patterns that show you turning points in the market. The second group is continuation patterns. So these are the two things that will ever happen in the market. It will either reverse or it will continue. Reverse a trend or continue a trend. That's basically what you'll look at in the market. Now, reversal patterns, there are more reversal patterns that exist than continuation patterns. So first point, reversal, continuation patterns. Second point, each of the patterns that I've listed here take a specific amount of time to form. So what I'm trying to say is a candlestick pattern will either take 1 day, 2 days, 3 days, or 4 days or more to actually form. So the actual time, the timing of that candlestick pattern is very important because it tells you, how early or late you will get the signal. Obviously, a candlestick that takes 1 day or maybe 1 minute if you're looking at the intraday chart, 1 week, this will be a very kind of good leading indicator. 2 days, 3 days, 4 or 5 tend to be more rare and they take longer to wait for. Doesn't mean that they're any better or worse, but just keep in mind that it helps you understand what that pattern is. Is it a 1 day pattern? Is it a 4 day pattern? But also how long it will take for that pattern to form and ultimately confirm. Is that clear to everyone? So the amount of time it takes for the pattern to form allows you to fast track your learning in candlestick patterns. So out of the 100 plus candlestick patterns that exist, keep in mind that understanding how long the pattern takes to form really helps you fast track your understanding and, most importantly, your application of these trading techniques. So there are 1 day patterns, 2 and 3, 4 and 5. This is a list. I can email this to you if you email me here at MIG Bank if you want the list. But I just want to move on to the final examples before we end this webinar. I want to end on an example of a Doji candlestick pattern. So remember, those of you should know that a Doji candlestick pattern is basically showing you that the open and the close are the same or near enough. So a market opened and closed at the same price or near the same price. Is that clear to everyone? The market opened and closed at the same price level or near the price level. So nothing much has happened. It tends to show that the market is tired. Now, a quick example that I want to show to you is this example, an old example of silver, and I will actually end on this final example. This is an example of silver, and in this example here, from the right arrow onwards, so on the right side of this white arrow, this section here, I would like everyone to tell me how many Doji patterns they see on this chart of silver. So remember, Doji looks like either one of these patterns. How many Doji patterns do you see on the right side of this chart? So I need everyone to kind of quickly type in a number. 1, 2, 3, 4. We can start a bidding war. Okay, some people say 1, some people say 3. Any more? Someone says 5. Someone said 0. That's not so promising. but fair enough. Some people say 7, so a lot of Doji patterns. This isn't a right or wrong answer, so I have again chosen a very difficult answer just to make sure each of you are learning as much as possible. Some people say 2. So we've got a big kind of broad base of responses here, which is always a good sign. Most people have said 7. I'd say, yeah, you're absolutely right. Depends on the trend. Thank you very much. That's actually the key answer. But I'll just quickly give you my interpretation. 1, 2, 3, 4, and 5. Now, some of you said more than 5. I would actually agree with you. But before I tell you where that other Doji pattern is, someone right at the end just said it depends on the trend. Now, you're absolutely right. It depends on the trend. Now, it depends what type of trend you're looking at, but let's just say this trend generally. You can see Doji 1 and 2, the trend was sideways. And that basically doesn't give you much signals. More than that, you need the market to then confirm that there might be a reversal. So you didn't get a close, you didn't get a move beneath the low of Doji 1 or 2 to signal to you that the market might be reversing lower. And the market indeed continues higher. Then we have example 3 and 4. 3, 4, and 5. Now again, we draw a resistance line here above the previous high, and you can see here, once again, the market does not close beneath the low of Doji 3, 4, or 5. In fact, the Doji 5 pushes higher. So that just shows you this is another continuation signal. So for those of you that kind of hate attending webinars or presentations where people show you examples which worked well time and time again, this is not one of those webinars. I detest those types of presentations. And so I'm showing you examples of signals that don't work well, so that you can basically reduce the amount of bad examples that you might find in the market. But obviously, to complement that, I will show you a good example. Can anyone see the final doji, the most important doji here on the candlestick chart, which I have not highlighted? Can anyone show me the 6th doji, just to kind of complete this webinar? The last candle, well done. Everyone is switched on, well done. We have a lot of smart people here on the FX Street webinar, and it's the very first, very final doji. And that definitely shows you that the market is tied. Look at the scale here. You can see silver was just off 4.5, almost doubling in value up to $8.50. This is way back in 2004. But the market doubles in value, and after a strong push here and then another strong push, then you get the doji. Keep in mind that you also had an upper shadow showing you that buyers were losing control just the previous day before the doji appeared. This is a very good example, textbook example of how a signal can actually be used successfully. Doji 1, 2, 3, and 4, and 5 show you bad signals that you should not trade in the market, especially if you are not given price confirmation of that potential trading signal. Remember, you need trend and you need confirmation of that reversal for you to really make a trading decision. Now, the final point here, although it's a very good signal, in itself, it's still not something you should trade in isolation. Again, keep in mind the rules that I just said. You need to identify the trend. You also need to highlight any kind of closing point. Now, the trend is obviously up. It does look like it's about to be exhausted, but you need to close. You need to close above the previous high or the previous low. So practically, if this was a market that you'd be trading tomorrow morning on any FX or any other market out there, keep in mind that if you had a wonderful trading setup like this, you would need to see the market close above the high or below the low. And indeed, this is what happened. The market not only closed below it, it crashed in a very big way all the way down to 5.5. So obviously, this is a great prepared example that I'm showing you, but I'm also showing you bad points and good points in this trading analogy. Now, I'm going to end off on that point and just end off on this point. This is my point about trends and the actual context of the market. It really does matter if the market is trending or ranging. Knowing the candlestick pattern, please attend our exclusive 3-hour webinar next time, and the FX Street team will actually post it in the chat shortly. We'll go through all the different candlestick patterns, but keep in mind that aside from learning all the patterns, you need to identify the location of the pattern. Is it in a trend or is it in a range? If it's in a trend, that's a lot more valuable. If it's in a range, it's a lot less value. So trends need to be identified for you to actually identify any potential reversal in the market. A range doesn't really isn't something that you can really trade that easily. Now, someone just asked in the chat, is a doji at the top of a trend any more powerful than the one at the bottom? Very good question. Something that I might include in the next webinar. One answer to your question is actually written here, and that's here where I say markets fall faster than they rise because fear is greater than hope. So that actually helps you understand why a doji at the top of the market can actually be more powerful than a doji at the bottom of the market, because of the simple emotional fact that markets fall faster than they rise, because fear is greater than hope. And so for that reason, doji patterns that you see at the top of the market can actually be very important, because you tend to get dramatic collapses. One of the humorous proverbs which Japanese analysts have said time and time again, fear doesn't ride out on a donkey. It's a funny quote, but it makes the point that fear and market declines tend to be fast, not slow. So if you see a doji pattern which highlights a potential reversal on a market top, that tends to be more important than a doji at the market bottom. Does that help answer your question? I've done various testing on this as well, so I have various kind of back testing results on them. In the next webinar, I should actually have a document ready, so I will actually try and send that to you. But just keep in mind trends and ranges. To get a reversal, and remember most candlestick patterns are reversal patterns, you need to identify a trend first. If there isn't a trend, it's not so helpful. And certainly a range-bound market doesn't really offer you that much information. Now, the last thing I want to quickly show you is I'm just maybe quickly show you some quick patterns. One-day pattern, a hammer pattern. Again, there's not enough time to go through this, but this is a hammer pattern. You can see here the lower shadow showing you buyers losing strength. A great example of this was a hammer pattern on Japanese yen. The big sell-off we had after the earthquake, where the market lost just over 400 pips in 20 minutes. That was a hammer pattern, the market searching for a low. Then, of course, we have an engulfing pattern. That's a 2-day pattern. There are many other patterns, but I'm just showing you engulfing pattern. An example of an engulfing pattern was on oil when it peaks out in March, end of March. That was a very important engulfing pattern. That's basically one trading session engulfing the previous one. And this happens to be a bearish engulfing pattern. Now, that was very important because it highlighted a resistance area which the market popped above, generated a doji pattern. You can see here the long shadows on the lower and upper side, and then made a double top pattern within this triangle or wedge-like pattern, and finally corrected lower. So you can see here how you can put all the kind of different pieces of the jigsaw puzzle together to get a very kind of important market top in oil. Okay. Might not have time to show you the 2-day slide again, sorry. Then finally, a 3-day pattern. Remember, I'm going in terms of number of days, 1, 2, and 3. 3-day pattern, I'm going to show you 3 white soldiers, which is basically a bullish signal, 3 consecutive candlestick patterns, full consecutive patterns on the Dow Jones Index. This actually happened at the end of Q2, the beginning of Q3, when a lot of portfolio managers were kind of rescaling their numbers just to kind of make them look even more attractive for their clients. We had a fantastic rally in the stock market, and in terms of candlestick patterns, we had not 3, but 1, 2, 3, 4, 5 consecutive candlestick patterns moving higher. So a very strong illustration of a rise in the market. That also, for some of you who are interested in indicators, showed quite well on the market breadth, the market internal. And so the name of this pattern is 3 white soldiers, or in this case, 4 or 5 soldiers. It's just basically showing you very strong price action on the upside. Now, what we don't have time for is the very last point here, profitable strategies. So in the next session, we'll focus on power of confluence, filtering signals using key indicators. I will talk about the market indicators, which is one of the indicators which I use quite a lot, and golden trading principles. I'm going to quickly actually just show you the golden trading principles just quickly, because I want to make sure you get as much information in this webinar as possible. Write these down if you get a chance. Wait for the session close to confirm. Do not use candles in isolation. Always consider risk-reward ratios before placing a trade with a candlestick signal. Candles do not offer price targets, so you have to use other techniques in addition to candlestick patterns. And then finally, remember the importance of stops. I will end off on that point, and just end off again on my contact details. My email address is r.william@migbank.com. If you'd like to contact us for any questions or any charts or anything on what I covered here, or even to receive our research for 1 month free trial, again, that's something I'm more than happy to extend. Thank you very much to FX Street team for giving me this opportunity again. It's always an honor and a pleasure to share knowledge with all of your audience. And thank you very much for everyone for attending. I hope it's been interesting, all the way here from Switzerland at MIG Bank. Happy market trading. Japanese Candlesticks is the way to understand market timing. I hope you found it interesting. And see you at the next webinar. The FX Street guys should actually put the monthly webinar in if they haven't already. It's on the 21st of July. It's a monthly webinar, exclusive webinar at FX Street. Thank you very much. All the best. Happy greetings. Bye-bye.